WTI crude oil hit $79.20 on July 13th, a 9.3% surge from $72.45 just 2 sessions earlier. That magnitude of move forces airline treasury desks to revise fuel cost projections, pushes inflation modelers to update their next CPI call, and gives Fed watchers reason to reassess the rate cut path. Oil does not move that fast without a specific driver. This video breaks down what likely caused it and exactly which sectors feel the impact. The prior close of $72.45 placed crude squarely in the low to mid-70s, a range that kept refinery margins comfortable and the energy component of the consumer price index relatively contained. Crude had been caught between two opposing forces, OPEC-plus managing output to defend a price floor on one side, and uneven global manufacturing demand on the other. That balance held for a sustained period before this week. A 9.3% move in 2 sessions tells you something in that equilibrium broke. Crude moves this fast for one of 3 reasons. First, a supply shock, an unplanned OPEC-plus production cut, a geopolitical event threatening physical oil flows, or a refinery outage that tightens available inventory. Second, an inventory draw. If the Energy Information Administration's weekly U.S. crude stockpile report shows a sharp unexpected drawdown, that tightness gets priced in by futures traders immediately. Third, a dollar effect. Because oil is priced in dollars globally, when the dollar weakens, crude's nominal price rises even if the underlying supply-demand balance has not changed. The Fed funds rate stood at 3.63% as of May 2026, a cutting posture that has applied consistent downward pressure on the dollar over recent months. Any one of these mechanisms can move crude sharply. 2 or 3 acting together can produce a 9.3% swing. Here is the direct link to the broader economy. Energy is a first-order input into the consumer price index. Gasoline, fuel oil, and utility costs all feed directly into the headline CPI reading. As of May 2026, the CPI index stood at 333.979. A crude move of this size, if it holds for several weeks, flows through to pump prices and appears in the following month's CPI print. That matters right now because the 10-year Treasury yield was already sitting at 4.56% as of July 10th, nearly 93 basis points above the Fed funds rate of 3.63%. That gap reflects the bond market's existing pricing of longer-run inflation risk. Crude at $79.20 adds direct upward pressure to that already elevated picture. On the equity side, rising crude is a direct tailwind for upstream producers and mid-cycle refiners. Chevron, Marathon Petroleum, and Phillips 66, tickers Chevron, MPC, and PSX, see margin expansion when WTI climbs, because the gap between crude input costs and refined product prices typically widens when demand stays stable. With the unemployment rate at 4.3% as of May 2026, there is no visible demand collapse in the current data to compress those margins from below. The Energy Select Sector ETF XLE captures this upside broadly across the segment. The other side of this trade is the transportation stack. Airlines carry direct jet fuel exposure, and only a portion of that can be hedged at any given time. American Airlines, Delta, and United, tickers AAM, DIL, and UAL, each carry fuel as one of their 2 largest operating cost items. A move to $79.20 per barrel from the low 70s translates directly into higher fuel bills per departing flight, compressing margins until either crude retreats or carriers reprice tickets. Below airlines, trucking and ground logistics operators face the same cost headwind, with somewhat more flexibility to pass it through via fuel surcharges. The consumer ultimately absorbs this through delivery fees and freight-linked goods pricing. Whether this 9.3% move holds or reverses depends on 3 variables that will clarify in the coming weeks. First, the Energy Information Administration's weekly petroleum inventory report. A continued draw confirms supply tightness and supports prices at this level. A surprise build suggests the spike was short-lived. Second, Federal Reserve communication. At a funds rate of 3.63%, there is room to hold or resume cuts, but a crude-driven CPI resurgence narrows that window considerably. Third, the OPEC-plus compliance picture. If this move reflects members enforcing production discipline after a period of overproduction, the supply tightening could be durable. If it traced to a one-off event, crude gravitates back toward the low 70s. The $79.20 print is real data. What follows it will tell the story.